Danish pharmaceutical giant Novo Nordisk reported stronger than expected profits powered by sales of anti-obesity and diabetes drugs.
Eli Lilly boosted its revenue guidance for the full year, citing strong demand for, big shocker here, GLP-1 drugs.
If you were to compare the stock performance of Apple, Google, AMD, and Eli Lilly over the past year, would you be surprised that Eli Lilly beat them all? Taking it a step further, if you compare each of those companies over the past 5 years, Eli Lilly continues to beat them all by over 100%. Healthcare and pharmaceutical stocks and ETFs rarely get much attention, but with advances in medicine by leveraging all the tools that technology offers, the healthcare sector is going to have tremendous upside over the next several years. And we're seeing it play out today, where people are more than willing to shell out $1,000 or more a month for their Mounjaro weight loss drug referred to as a GLP-1 drug that allows patients on average to lose 20% of their weight. And clearly, I have not been taking that drug, mostly because I'm not willing to pay $1,000 a month. Now, I realize that this video is on ETFs, but if you're on the fence on buying Eli Lilly stock, they just upped their yearly forecast by $2 billion. And they've tapped out on capacity, while their demand on their products far outweighs what they can produce by several multiples. And the thing is, this isn't a one-off pharmaceutical win. Just look at the speed and the efficiency in creating the COVID vaccine. By all accounts, that was pretty incredible. And we're just now on the cusp of building up AI models and tools that can be used to speed up medical breakthroughs. But in taking a step back, why would a person even be interested in biotech and pharma ETFs today? Isn't a person's portfolio fully covered by having an index to the S&P 500, a strong dividend ETF, and also a high growth ETF? I mean, really, isn't that all a person really needs? And the answer is sure. Well, maybe, or maybe not. Regardless, I'm going to go over 3 different reasons why the healthcare sector is worth having in your portfolio, and then I'll review 4 different ETFs from the sector that may be worth investing in. And as usual, I do have a spreadsheet linked in the description below of all the funds that I'd reviewed for this video, and you may want to look at this one in particular because there are a lot of dogs that are not worth investing in. Let's get right into the nuts and bolts regarding the reasons healthcare ETFs are worth having. Traditionally, the healthcare sector has had consistent growth with extreme low volatility. So what exactly do I mean when I say low volatility? Well, one measure is to look at a stock or an ETF's beta, where it measures the volatility of the asset compared to the market, like the S&P 500. If the beta is above 1, then it's more volatile and it has more momentum both with its ups and its downs. These would be growth stocks that you'd see most likely tied to technology. And a beta of less than 1 means that the security is more stable and it's smaller growth, and also much lower losses than the market has. And this is often associated with utilities, but parts of healthcare also have very low betas. To help paint this picture, if we look at the 2001 recession, I'm using a healthcare index referenced by the ETF 𝐓𝐸, where it weathered the recession better than the S&P 500 with a 30% improvement over the market. And during the 2008 recession, it outperformed the S&P 500 by 11%. So my first point in having a healthcare-related ETF is as a defensive option against market downturns. You can use the healthcare sector for long-term defense, or you can use it as a tactical short-term sector move if there's uncertainty in the market. And I'll say that again, if there's uncertainty in the market. But just because a sector is less volatile, it doesn't mean that you have to settle for an extremely low return. Then moving to my second point, which is that some healthcare companies have very good returns that may shift over to become high growth. And I believe that's because biotech and pharma will benefit greatly from all of the technology breakthroughs that are happening with AI modeling. As a quick example, the NYU Grossman School of Medicine worked jointly with Meta to create a model to reconstruct MRI scans that are 4 times faster than a traditional scan. This allows nearly 3 to 4 times more patients to get an MRI in a given day. The applications of AI within healthcare are barely even scratching the surface, where it's going to increase the speed and the accuracy of diagnosing diseases, streamlining the administrative tasks, and enhancing the research and the development of brand new drugs. A person simply needs to go back to my example about Eli Lilly and compare that to how they are investing heavily into AI, which is showcased in both their investments and in their job postings. So my second point is that healthcare has been defensive, but it may quickly change over to become a high growth sector. And my third point is that many of the healthcare ETFs in stock offer healthy dividends, if that's a priority for you. However, I'm not making dividends a focus in this video, but I will share one ETF with a healthy dividend as just a quick example. Now I'll get started with the first ETF of iShares US Medical Devices ETF with the symbol IHI, where the strategy is different than all of the other ETF in that it focuses on the manufacturers of healthcare devices, where if you look at the top holdings of this ETF, you'll see companies like Medtronic, Boston Scientific, and one of my favorites, Intuitive Surgical. And if you aren't familiar with Intuitive Surgical, they make surgical robots like the 𝐓𝐸 system to aid in surgeries. And with over 14 million procedures under their belt, I think that systems like these will become much more mainstream, especially since they are extremely sterile and procedures are considered to be much less invasive than procedures of the past. As for the IHI ETF, I want to point out that the beta being a 0.94, which is below the market index of a 1, making it less volatile, but very close to the market itself. From there, it has an expense ratio of 0.4%, which is pretty much average for the category, and it has a dividend yield of 0.54%, which honestly isn't even really worth mentioning. The unfortunate part of this ETF is its performance year to date is okay at 2%, but the 3-year is bad at a negative 4%. And analysts speculate that most of that 3-year downturn in medical devices is due to ripples from the pandemic, meaning that hospitals have held back on investing in robotic systems for surgeries, and also patients have been holding back from getting necessary procedures. But that's where the potential comes into play, where I expect the last half of 2024 and early 2025 to pick up for medical devices. Now, in going back to the performance, the 5-year was a respectable 53% in total return, but the real interesting part is that over 10 years, they are up 266%, which handily beat the S&P 500 that's only up 226% over the past 10 years. In addition, analysts see this ETF as having nearly a 20% upside in performance for the rest of the year. And as I had mentioned at the beginning, biotech and healthcare can be high growth and not just defensive. For example, I spoke about the company BioStem Technologies last year, and they are up 350% since then. And the analysts are bullish, where Zacks has nearly a 100% upside listed for a target for the rest of this year. As a refresher, they're exploring regenerative medicine. What that means is that they utilize tissue allografts in the areas of diabetic wound care as well as surgical wound care, resulting in a faster healing with reduced pain. This is the beginning for the company, where they look to use the body's ability to heal itself in the areas of regenerative health. Basically, the body uses its own system to rebuild tissue and organs. Wound care happens to be the starting point, where there's much more potential in the areas of organ damage caused by age, disease, radiation treatments, and just basic injuries. This is an area at the forefront of biotech that has massive potential, so be on the lookout on your watch list for BioStem Technologies. I'll be curious to check on this next year to see if it's up that 100% that the analysts project. Let's now move on to the Vanguard Healthcare Index Fund with the symbol VHT, where the fund has hundreds of stock creating a broad exposure to the index against healthcare. And in looking at the top holdings, Eli Lilly is at the very top, and then you have some of the top players you'd expect like United Health, J&J, and Merck. And when we look at the beta, it's at 0.66, which is extremely risk averse, and it comes with a low expense ratio of 0.1%. And it has a notable dividend yield of 1.35%. And when we look at performance, it's okay for a risk averse investment at just over 11%, and the 5-year and the 10-year are just okay. This is the broad market index of the group and is very much a defensive fund with over 400 holdings. As for analysts, they're showing a little bit of love with a forecast of 18% on average for the year. Now, before moving on, I do have a favor to ask of you. If you like my content and especially my spreadsheets, then please press the like button so my channel can continue to grow. And I'd love it if you'd consider subscribing so you can be up to date with all my latest content. Next on the list is the Healthcare Select Sector SPDR fund with the symbol XLV, where the top holdings are very similar to the previous fund from Vanguard, but the difference lies in the fact that this fund only has 66 holdings and is much more focused on the growth aspect of the healthcare sector. This fund has the highest trading volume, which gives it more liquidity if you need to sell in a hurry. And the beta is also incredibly low at 0.61. And I have to point out that the expense ratio is the best of the group at 0.09%. And it has one of the better dividends at 1.56%. And when we look further into the performance of the fund, it has the best 1-year and 3-year performance of any other healthcare funds that I spoke to today. Even the 5 and the 10-year total returns were decent for the role that they play. And when we step back and look at the analyst projections, they have the fund with nearly a 15% upside for the year. Now, I did mention that I'd give a quick bonus ETF for a dividend, and that would be the Global Healthcare Covered Call and Growth ETF with the symbol 𝐓𝐨𝐻. And similar to some of the more famous dividend funds like Devo, this one uses the call option to earn a little bit of extra cash. In doing so, it has a dividend yield of 6.8%, but the problem is that this fund is less than 2 years old, so there really isn't much history for me to review. And that's why it didn't even come close to making my list for today. But for those of you that are dividend focused, this may be a fund that you want to put on your watch list given the strong dividends for such a low volatile sector. As I mentioned at the beginning, the biotech and pharma stock funds have predominantly been defensive investments, and that still holds pretty much true today. But with the boomer generation making up 21% of the population and needing more reliance on the medical system, the demand and growth for this sector has a lot of runway to go. And when you layer on the advancements and the investments being made into AI, the healthcare industry should see a major boom over the next decade. Please don't forget that I have a spreadsheet with all of the funds that are reviewed for today's video down in the description. And a huge thanks goes out to today's sponsor, BioStem Technology. Thanks so much for watching.